The Global Reporting Initiative, GRI. A comprehensive guide to sustainability reporting. Course content. Introduction. Part 1. Introduction to Sustainability and Reporting. Part 2. Overview of the Global Reporting Initiative, GRI. Part 3. Core components of GRI standards. Part 4. Materiality and stakeholder engagement. Part 5. Preparing a GRI report. Part 6. GRI disclosures explained. Part 7. Case studies of GRI reporting. Part 8. The role of technology in GRI reporting. Part 9. Assurance and verification in GRI reporting. Part 10. Future trends in GRI reporting. Introduction. In today's interconnected world, the concept of sustainability has become a vital pillar for businesses, governments, and society at large. The pressing challenges of climate change, resource depletion, social inequality, and economic instability demand a new way of operating, one that balances the needs of people, planet, and profit. Organizations worldwide are recognizing that their long-term success depends not only on financial performance, but also on their environmental stewardship and social responsibility. This growing awareness has fueled the rise of sustainability reporting, a practice that helps organizations measure, disclose, and manage their impact on the environment and society. Among the various frameworks developed to guide these efforts, the Global Reporting Initiative, GRI, stands out as the most widely adopted and comprehensive sustainability reporting standard globally. Founded in 1997, the GRI provides organizations with a structured framework to communicate their environmental, social, and governance (ESG) performance transparently and consistently. By using GRI standards, companies can identify and disclose their most significant impacts, engage with stakeholders, and demonstrate accountability. This transparency not only builds trust with investors, customers, and communities, but also drives better decision-making internally. Despite the increasing adoption of GRI reporting, many organizations find the process complex and challenging. Understanding the principles, selecting the right standards, collecting accurate data, and effectively communicating results require dedicated effort and expertise. This course aims to demystify the GRI framework by providing a comprehensive step-by-step guide that will help you master sustainability reporting and leverage it as a powerful tool for positive change. Whether you are a sustainability professional, business leader, academic, or student, this course will equip you with the knowledge and practical insights needed to navigate the evolving landscape of sustainability reporting. We will explore the origins and development of the GRI, break down its core components, explain how to conduct materiality assessments, and examine real-world case studies that illustrate best practices. As the world moves toward greater accountability and transparency, understanding and applying GRI standards is no longer optional, but essential. This course is your companion on that journey, providing clarity, guidance, and inspiration to help you contribute meaningfully to a sustainable future. Welcome to the journey of learning about the Global Reporting Initiative, where sustainability meets transparency, and every report tells a story of impact and responsibility. Part 1. Introduction to Sustainability and Reporting. What is sustainability? Sustainability, at its core, is about meeting the needs of the present without compromising the ability of future generations to meet their own needs. This simple but profound definition emerged from the 1987 Brundtland Report by the United Nations, which highlighted the interconnected nature of environmental health, social equity, and economic viability. In practical terms, sustainability involves managing resources responsibly, reducing negative environmental impacts, promoting social well-being, and ensuring long-term economic prosperity. It is a holistic approach, recognizing that environmental degradation, social injustice, and economic instability are deeply linked challenges that must be addressed together. The 3 pillars of sustainability. Environmental sustainability protecting natural ecosystems, conserving resources, and reducing pollution and greenhouse gas emissions. Social sustainability, promoting human rights, fair labor practices, community engagement, and social equity. Economic sustainability, supporting stable economic growth, responsible business practices, and long-term financial health. Understanding these pillars helps organizations identify their impacts and responsibilities across a broad spectrum. The importance of sustainability reporting. As awareness of sustainability issues grows, so does the demand for transparency. Stakeholders, including investors, customers, employees, regulators, and civil society, want to know how organizations are managing their impacts and contributing to sustainable development. Sustainability reporting is the process by which organizations disclose their environmental, social, and governance (ESG) performance. It enables accountability, demonstrating responsibility for impacts on people and the planet. Transparency, providing clear, comparable information about policies, practices, and results. Decision-making, helping internal leaders make better choices by understanding risks and opportunities. Trust-building, strengthening relationships with stakeholders through honest communication. Regulatory compliance, meeting increasing legal requirements and international expectations. Well-prepared sustainability reports also drive continuous improvement, as they highlight gaps, successes, and areas needing attention. Evolution of sustainability frameworks. The practice of sustainability reporting has evolved over the past few decades, shaped by growing global environmental and social concerns. Early developments. In the 1990s, organizations began publishing environmental reports primarily focused on compliance and pollution control. These reports were often voluntary and lacked standardization, making comparisons difficult. Emergence of frameworks. To address this, various frameworks emerged to guide sustainability reporting. Global Reporting Initiative, GRI, launched in 1997 to provide standardized guidelines for sustainability disclosure. Accountability's All 1000 series, focusing on stakeholder engagement and assurance. Carbon Disclosure Project, CDP, specializing in climate-related disclosures. Sustainability Accounting Standards Board, SASB, concentrating on financially material ESG factors. Task Force on Climate-Related Financial Disclosures, TCFD, targeting climate risks in financial reporting. Why GRI? Among these, GRI became the most widely adopted due to its comprehensive coverage of economic, environmental, and social topics, and its emphasis on stakeholder inclusiveness and materiality. It set the foundation for what sustainability reporting looks like today, driving global consistency and transparency. Summary. Sustainability is a complex, multidimensional concept that requires organizations to consider environmental, social, and economic impacts together. As the need for transparency increases, sustainability reporting has become a crucial practice for responsible business management. Over time, frameworks like the Global Reporting Initiative have provided standardized methods to measure, disclose, and improve sustainability performance, enabling organizations to communicate their commitment to a sustainable future effectively. Part 2. Overview of the Global Reporting Initiative, GRI. History and mission of GRI. The Global Reporting Initiative, GRI, was founded in 1997 as a multi-stakeholder process aimed at developing standardized sustainability reporting guidelines. The initiative emerged from growing demand among businesses, governments, and civil society for transparent and comparable information about organizations' environmental, social, and economic impacts. The original goal was simple yet ambitious: to create a globally accepted framework for sustainability reporting that would encourage organizations to be more transparent about their sustainability performance and impacts. Over the years, GRI has evolved to become the most widely used sustainability reporting framework worldwide, adopted by thousands of organizations across sectors and geographies. Mission statement. GRI's mission is to empower decision-makers everywhere with the information they need to build a more sustainable economy and world. By fostering transparency and accountability, GRI aims to improve sustainability performance and stakeholder trust. Key principles and structure. GRI standards are built on several fundamental principles designed to ensure relevance, accuracy, and reliability in sustainability reporting. Stakeholder inclusiveness. Organizations identify and engage with stakeholders to understand their needs and expectations. Sustainability context. Reporting reflects the broader context of sustainable development. Materiality. Focuses on issues that significantly affect the organization's economic, environmental, and social impacts. Completeness. Covers all material topics and their boundaries to give a full picture. Balance. Presents both positive and negative aspects of performance. Comparability. Enables users to compare information across organizations and time. Accuracy, timeliness, clarity, and reliability. Ensures information is correct, up-to-date, clear, and can be trusted. GRI standards versus GRI guidelines. Originally, GRI published guidelines that provided general recommendations on sustainability reporting. These were periodically updated and widely adopted. In 2016, GRI transitioned to a modular, standards-based approach, the GRI standards, to enhance usability and clarity. The standards offer a more flexible, dynamic framework and are structured into 3 series. Universal standards. These apply to all organizations and cover the basics of reporting, including GRI 101, Foundation, introduces the reporting principles and concepts. GRI 102, General Disclosures, covers organizational profile, governance, ethics, and stakeholder engagement. GRI 103, Management Approach, explains how to report the approach to material topics. Topic-specific standards. Divided into 3 categories, these standards focus on economic, environmental, and social topics. Economic standards, e.g., GRI 201, Economic Performance, GRI 203, Indirect Economic Impacts. Environmental standards, e.g., GRI 302, Energy, GRI 305, Emissions, GRI 306, Waste. Social standards, e.g., GRI 401, Employment, GRI 403, Occupational Health and Safety, GRI 412, Human Rights. Sector standards, upcoming. GRI is developing sector-specific standards tailored to the unique impacts and reporting needs of different industries. How organizations use GRI. Organizations use GRI standards to identify their most significant sustainability impacts, collect and manage data related to these impacts, prepare transparent and credible sustainability reports, engage stakeholders meaningfully, benchmark and improve sustainability performance. The flexible, modular design allows organizations of all sizes and sectors to apply the standards in ways that best suit their context and reporting objectives. Summary. The Global Reporting Initiative has transformed sustainability reporting by providing a robust, globally recognized framework that promotes transparency, comparability, and accountability. Its modular standards approach allows organizations to disclose their sustainability performance comprehensively and meaningfully. Understanding GRI's history, mission, and structure is essential for effectively using the framework to communicate sustainability impacts and drive positive change. Part 3. Core components of GRI standards. Introduction to GRI standard structure. The GRI standards are designed as a modular system that organizations can tailor to their sustainability reporting needs. This structure ensures flexibility, relevance, and consistency across diverse sectors and regions. Understanding the core components is key to effectively applying the GRI framework. The three main categories of GRI standards are universal standards, topic-specific standards, sector standards in development. This part focuses on the universal and topic-specific standards, which are essential for most reporting organizations. Universal standards. The universal standards provide the foundation for preparing a sustainability report and include three key parts. GRI 101 Foundation. GRI 101 introduces the key concepts, reporting principles, and requirements. It explains the purpose of sustainability reporting and how to use the GRI standards. This standard sets the stage by emphasizing the importance of stakeholder inclusiveness, the process of conducting a materiality assessment, how to define report content and quality, requirements for preparing a report in accordance with GRI standards. GRI 102 General Disclosures. This standard requires organizations to disclose contextual information necessary for users to understand their sustainability impacts, such as organizational profile, name, location, size, ownership, governance structure and management approach, ethics and integrity policies, stakeholder engagement practices, reporting practices, scope, boundaries, reporting period. These disclosures provide transparency about the organization itself and the way it manages sustainability. GRI 103 Management Approach. GRI 103 explains how organizations should describe their management approach to each material topic. It requires disclosures in three parts. 103-1 Explanation of the material topic and its impacts. 103-2 The organization's management approach, including policies, commitments, and responsibilities. 103-3 Evaluation of the management approach's effectiveness. This section helps users understand not only the impact, but how the organization addresses it. Topic-specific standards. Topic-specific standards are organized into three series: economic, environmental, and social. Organizations select and apply the standards relevant to their material topics. Economic standards. These standards cover an organization's economic impacts, both direct and indirect, such as GRI 201, economic performance, revenue, costs, financial assistance, economic value generated and distributed. GRI 203, indirect economic impacts, investments in infrastructure, services, and impacts on local economies. GRI 204, procurement practices, spending on local suppliers and policies regarding procurement. Environmental standards. These standards address the organization's interactions with natural systems. GRI 302, energy consumption and efficiency measures. GRI 303, water and effluents, water withdrawal, consumption and discharge. GRI 305, emissions, greenhouse gas emissions, ozone-depleting substances, and other pollutants. GRI 306, waste generation and management. Social standards. Social standards focus on impacts on people within and outside the organization. GRI 401, employment, workforce composition, turnover, benefits. GRI 403, occupational health and safety, injury rates, health and safety management. GRI 404, training and education, employee development and skills training. GRI 405, diversity and equal opportunity, gender balance, diversity policies. GRI 406, non-discrimination, incidents of discrimination and corrective actions. GRI 412, human rights assessment, operations subject to human rights reviews. How to choose relevant standards. Materiality assessment is crucial for selecting which topic-specific standards to apply. Organizations must identify issues with the most significant economic, environmental, and social impacts. Consider stakeholder concerns and expectations. Reflect industry-specific and geographical factors. Only topics deemed material are reported, ensuring reports are focused, meaningful, and manageable. Sector standards. Brief overview. GRI is developing sector-specific standards tailored to particular industries, recognizing that different sectors face unique sustainability challenges. Once finalized, these standards will complement universal and topic-specific standards, providing even more relevant guidance. Summary. The GRI standards modular structure empowers organizations to report sustainability information that is both comprehensive and customized to their context. Universal standards establish the foundation and ensure transparency about organizational practices, while topic-specific standards cover the detailed economic, environmental, and social impacts. Choosing relevant standards through materiality assessments ensures reports are meaningful and focused. Part 4. Materiality and Stakeholder Engagement. Understanding materiality in GRI reporting. Materiality is a cornerstone of sustainability reporting and a guiding principle within the GRI framework. It refers to the process of identifying the most significant topics that reflect an organization's economic, environmental, and social impacts, those that influence the decisions of stakeholders or affect the organization's ability to create value over time. Unlike financial materiality, which focuses primarily on what affects investor decisions, GRI adopts a broader concept called double materiality, recognizing that an organization's impacts on the environment and society are also material regardless of immediate financial implications. Why materiality matters. Focus and relevance. It helps organizations concentrate reporting efforts on the most critical issues, avoiding information overload. Stakeholder trust. By addressing the concerns that matter most to stakeholders, organizations build credibility and legitimacy. Strategic management. Materiality assessments inform decision-making, risk management, and opportunity identification. The materiality assessment process. Conducting a materiality assessment typically involves several key steps. Step 1. Identify potential topics. Start by compiling a comprehensive list of potential topics relevant to the organization's operations, sector, and geographical context. Sources include industry standards and benchmarks, regulatory requirements, stakeholder feedback, media, and sustainability trends, internal policies, and previous reports. Step 2. Engage stakeholders. Engage a diverse group of stakeholders to understand their perspectives on the organization's impacts and priorities. Common stakeholder groups include employees, customers and clients, investors and shareholders, suppliers and business partners, communities and local authorities, NGOs and advocacy groups, regulators. Engagement methods vary from surveys and interviews to focus groups and public consultations. Step 3. Prioritize topics. Using the information gathered, evaluate and prioritize topics based on impact on the economy, environment, and society, influence on stakeholder decisions and perceptions, potential risks and opportunities for the organization. This prioritization is often visualized through a materiality matrix, which plots topics by their importance to stakeholders and the organization. Step 4. Validate and review. Material topics and priorities should be validated with senior management and, where appropriate, with external stakeholders. Regular reviews are essential to keep materiality assessments current as business contexts and stakeholder expectations evolve. Stakeholder engagement, principles and practices. Stakeholder engagement is a continuous dialogue between an organization and those affected by or interested in its activities. It is crucial for gathering insights, building relationships, and ensuring accountability. Principles of effective stakeholder engagement. Inclusiveness. Identify and involve relevant stakeholders fairly and transparently. Openness and transparency. Share information openly and explain how input will be used. Responsiveness. Address concerns raised and provide feedback on actions taken. Timeliness. Engage stakeholders early enough to influence decisions. Respect. Acknowledge diverse views and cultural contexts. Methods of engagement. Surveys and questionnaires. Efficient for gathering quantitative feedback. Interviews and focus groups provide deeper qualitative insights. Workshops and roundtables facilitate dialogue and collaborative problem-solving. Public consultations, open forums for community and stakeholder input. Digital platforms, online tools, social media, and webinars enable broader reach. Reporting materiality and stakeholder engagement. GRI requires organizations to disclose how they identified and prioritized material topics. The process and methods used for stakeholder engagement. The list of stakeholders engaged and their key concerns. How stakeholder input influenced the report content and management approach. This transparency enhances report credibility and demonstrates responsiveness to stakeholder expectations. Summary. Materiality and stakeholder engagement are fundamental to meaningful sustainability reporting under the GRI framework. By systematically identifying and prioritizing significant topics and actively involving stakeholders, organizations can produce focused, relevant reports that support strategic decision-making and build trust. These practices ensure that sustainability disclosures reflect real impacts and stakeholder concerns, strengthening accountability and driving continuous improvement. Part 5. Preparing a GRI report. Introduction. Preparing a sustainability report aligned with the Global Reporting Initiative, GRI, involves a structured, methodical process. A well-prepared GRI report not only communicates an organization's sustainability performance clearly, but also supports transparency, accountability, and continuous improvement. This part outlines the key stages and best practices in preparing a GRI report, from planning to publication. Planning the report. Define the purpose and audience. Before starting, clarify why the report is being prepared and who the intended audience is. Common reasons include meeting stakeholder expectations for transparency, complying with regulatory requirements, enhancing reputation and trust, improving internal sustainability management. Knowing your audience, whether investors, customers, employees, regulators, or the public, helps tailor content and communication style. Establish governance and responsibility. Assign clear roles and responsibilities within the organization for the reporting process. This may involve a sustainability or CSR team leading the process, senior management endorsement and oversight, cross-functional involvement from departments like finance, operations, HR, and communications, external consultants or assurance providers if necessary. Set the reporting scope and boundaries. Decide the scope of the report, including organizational boundaries, e.g., subsidiaries, joint ventures. Geographic coverage. Reporting period, typically a fiscal or calendar year. Topics to be reported, based on materiality assessment. Clearly defining boundaries ensures consistency and comparability. Data collection and management. Identify data sources. Gather quantitative and qualitative data relevant to the material topics and GRI disclosures. Data sources may include internal databases, financial, environmental, HR, supplier and partner information, stakeholder feedback, policies and procedures documentation. Establish data quality controls. Ensure data accuracy and reliability by setting clear data definitions and measurement methods, documenting data collection processes, training data providers, conducting internal reviews and validations, address data gaps, identify missing or incomplete data early, and develop plans to fill gaps or explain limitations in the report. Drafting the report. Organize content according to GRI standards. Structure the report to include universal disclosures, organizational profile, governance, ethics, and stakeholder engagement. Management approach. For each material topic, explain how it is managed. Topic-specific disclosures. Present performance data and narratives for each material topic. Use clear and transparent language. Write in a straightforward style, avoiding jargon. Balance positive achievements with challenges or setbacks to maintain credibility. Include visuals and case studies. Graphs, tables, and infographics help readers understand data trends and impacts. Case studies illustrate real-life examples and demonstrate commitment. Internal review and assurance. Internal review. Circulate the draft report among key internal stakeholders for feedback and verification. This helps ensure accuracy and alignment with organizational priorities. External assurance, optional but recommended. Third-party assurance adds credibility by independently verifying the report's accuracy and completeness. Assurance can range from limited reviews to full audits. Publishing and communication. Publish in accessible formats. Reports are typically published online as PDFs or interactive web reports. Ensure the format is accessible and easy to navigate. Promote the report. Use multiple channels to share the report with stakeholders, including company website and social media, email newsletters, investor relations, communications, press releases, and media outreach. Continuous improvement. After publication, gather stakeholder feedback to improve future reports. Use insights from the reporting process to enhance sustainability management and data collection. Summary. Preparing a GRI report is a comprehensive process that requires careful planning, data management, clear communication, and quality assurance. By following a structured approach aligned with GRI standards, organizations can produce transparent, credible reports that build stakeholder trust and support sustainable business growth. Regular reporting also fosters a culture of accountability and continuous improvement. Part 6. GRI Disclosures Explain. Introduction to GRI Disclosures. In the GRI Standards Framework, disclosures are the specific pieces of information that organizations report to communicate their sustainability performance. Disclosures can be qualitative, such as descriptions of policies and management approaches, or quantitative, such as data on greenhouse gas emissions or workforce diversity. Understanding the types of disclosures and their purposes is essential for producing comprehensive and transparent sustainability reports. Categories of GRI disclosures. GRI disclosures are mainly categorized into general disclosures, management approach disclosures, topic-specific disclosures. Each serves a distinct purpose within the report. General disclosures. Found in GRI 102, general disclosures provide essential background information about the organization and the reporting process, helping readers understand the context of the sustainability report. Key elements. Organizational profile includes the organization's name, location, ownership, market served, scale of operations, and workforce size. Strategy. Information about the organization's values, mission, and sustainability-related strategies. Ethics and integrity. Details on codes of conduct, ethical guidelines, and anti-corruption policies. Governance. Description of the governance structure, board composition, and how sustainability is integrated at the governance level. Stakeholder engagement, identification of stakeholder groups, methods of engagement, and key topics raised during engagement. Reporting practice, scope, boundaries, reporting period, standards applied, and any external assurance. Management approach disclosures. Outlined in GRI 103, management approach disclosures explain how the organization manages each material topic. They include 103-1, the nature of the material topic and its impacts. 103-2, the management approach, including policies, responsibilities, and resources dedicated. 103-3, evaluation of the effectiveness of the management approach. These disclosures provide narrative context, showing readers how the organization addresses sustainability issues beyond just numbers. Topic-specific disclosures. Topic-specific disclosures provide detailed information on economic, environmental, and social impacts. They include both qualitative descriptions and quantitative data. Examples of topic-specific disclosures. Economic. GRI 201. Economic performance, revenues, costs, economic value generated and distributed. GRI 204. Procurement practices, spending on local suppliers, percentage of contracts awarded to local suppliers. Environmental. GRI 302. Energy, total energy consumption, energy intensity, reductions achieved. GRI 305. Emissions, greenhouse gas, GHG, emissions by scope, scope 1, 2, and 3, other emissions like ozone-depleting substances. GRI 306. Waste, types and amounts of waste generated, waste disposal methods, recycling rates. Social. GRI 401. Employment, new employee hires, turnover rates, benefits. GRI 403. Occupational health and safety, injury and illness rates, safety training, health and safety management systems. GRI 404. Training and education, average training hours, programs for skills development. GRI 405. Diversity and equal opportunity, workforce diversity data by gender, age, and other categories. GRI 412. Human rights, operations subject to human rights reviews and impact assessments. Customizing disclosures for your organization. Not all disclosures apply to every organization. Materiality assessments guide which topic-specific disclosures to include based on the organization's most significant impacts and stakeholder concerns. Organizations should ensure that disclosures accurately reflect actual performance, are consistent with organizational policies and practices, provide meaningful information to stakeholders, reporting on challenges and improvements. GRI encourages organizations to report transparently, including challenges and areas needing improvement. This honesty enhances credibility and demonstrates a genuine commitment to sustainability. Summary. GRI disclosures form the backbone of sustainability reports. General disclosures provide context, management approach disclosures explain how impacts are managed, and topic-specific disclosures offer detailed performance data. Selecting and reporting the right disclosures, based on materiality, enables organizations to communicate their sustainability story transparently, build stakeholder trust, and drive continuous improvement. Part 7. Case Studies of GRI Reporting. Introduction. Case studies provide valuable insights into how organizations from different sectors and regions implement the Global Reporting Initiative, GRI, standards. They highlight best practices, challenges faced, and the benefits gained from transparent sustainability reporting. This part presents a selection of case studies illustrating diverse approaches to GRI reporting. Case Study 1. Multinational Manufacturing Company. Background. A global manufacturing firm with operations in over 30 countries adopted the GRI standards to enhance its sustainability disclosures and meet stakeholder expectations. Approach. conducted a comprehensive materiality assessment involving employees, suppliers, investors, and local communities. Focused on energy consumption, emissions, labor practices, and community engagement. Established a cross-functional reporting team and implemented an enterprise-wide data management system. Included GRI Universal Standards disclosures to provide governance and organizational context. Used sector-specific metrics relevant to manufacturing. Outcomes. Improved data accuracy and consistency across business units. Enhanced stakeholder trust through transparent reporting. Identified opportunities for energy efficiency and waste reduction. Strengthened relationships with local communities via targeted social investment programs. Case Study 2, Financial Services Institution. Background. A leading bank in a developing country began using GRI standards to communicate its approach to environmental, social, and governance (ESG) risks. Approach. Engage stakeholders including regulators, clients, NGOs, and employees. Focused on economic impacts, anti-corruption, diversity, and financial inclusion. Disclose policies on responsible lending and investment. Reported on gender diversity in leadership and employee training programs. Used external assurance to validate the report. Outcomes. Enhanced reputation with investors and regulators. Increased awareness internally of ESG risks and opportunities. Set clear targets for improving diversity and inclusion. Received positive feedback from community stakeholders. Case Study 3, Small and Medium-Sized Enterprise (SME). Background. An SME in the food production sector sought to adopt GRI reporting to demonstrate its commitment to sustainability and attract eco-conscious customers. Approach. Performed a simplified materiality assessment, focusing on local environmental impacts and labor conditions. Reported on water use, waste management, and employee welfare. Collaborated with local NGOs to verify social impact claims. Published a concise, user-friendly sustainability report online. Outcomes. Strengthened brand reputation among customers. Gained new business opportunities through sustainability certifications. Improved internal processes for resource management. Built stronger partnerships with suppliers and community groups. Lessons learned from case studies. Tailor the process. Customize reporting scope and depth based on organizational size, sector, and resources. Engage stakeholders early and often. Continuous engagement enriches report quality and relevance. Invest in data systems. Reliable data collection is crucial for credible reporting. Transparency builds trust. Honest reporting of challenges fosters stakeholder confidence. Leverage reporting for strategic benefits. Use insights from the process to improve sustainability performance. Summary. These case studies demonstrate that GRI reporting is adaptable to organizations of all sizes and sectors. Whether a multinational corporation, a financial institution, or an SME, GRI standards help organizations communicate their sustainability impacts, engage stakeholders, and drive improvement. By learning from practical examples, organizations can better plan and execute their own sustainability reporting journeys. Part 8. The Role of Technology in GRI Reporting. Introduction. Technology plays an increasingly vital role in the preparation, management, and communication of sustainability reports aligned with the Global Reporting Initiative, GRI. From data collection and analysis to report publishing and stakeholder engagement, digital tools enhance efficiency, accuracy, and transparency. This part examines how organizations leverage technology to streamline GRI reporting and maximize its impact. Digital tools for data collection and management. Enterprise Resource Planning, ERP systems. Many organizations use ERP systems to integrate financial, operational, and sustainability data. These platforms facilitate centralized data storage and real-time access, improving data accuracy and reducing manual work. Sustainability reporting software. Specialized software solutions designed for sustainability reporting help organizations collect and validate environmental, social, and governance (ESG) data, track performance against GRI indicators, manage workflows and deadlines, generate draft reports aligned with GRI standards. Popular examples include Enablon, SAP Sustainability, and GRI certified platforms. Data analytics and visualization tools. Advanced analytics enable deeper insights into sustainability performance. Tools like Power BI or Tableau allow organizations to create dynamic dashboards and visualizations that highlight trends and anomalies, support scenario analysis and forecasting, facilitate stakeholder communication with clear visuals. Automation and artificial intelligence, AI. Automation reduces the time and effort needed for data entry and reporting. For example, automated data extraction from sensors, meters, and monitoring devices. AI-powered data validation to identify inconsistencies or errors. Natural language generation to produce narrative report sections based on data inputs. These technologies increase accuracy and free up human resources for analysis and strategy. Enhancing stakeholder engagement through technology. Online platforms and portals. Organizations use dedicated sustainability portals to share reports, gather feedback, and facilitate dialogue with stakeholders. These platforms offer interactive features such as commenting and discussion threads, surveys and polls, live Q&A sessions, social media and mobile apps. Social media channels expand the reach of sustainability communications. Mobile apps can provide stakeholders with instant access to reports and updates, fostering ongoing engagement. Digital publishing and accessibility. Digital publishing tools enable organizations to create interactive web reports with embedded multimedia, downloadable PDFs optimized for accessibility, multi-language versions for global audiences. These features improve user experience and make sustainability information more accessible. Cybersecurity and data privacy. As sustainability data becomes increasingly digital, protecting it from cyber threats is critical. Organizations must implement robust cybersecurity measures and comply with data privacy regulations to safeguard sensitive information and maintain stakeholder trust. Challenges and considerations. While technology offers many benefits, organizations should be mindful of initial costs and resource requirements, ensuring data quality despite automation, training staff to use new systems effectively, balancing transparency with confidentiality. Summary. Technology is a powerful enabler of effective GRI reporting. From streamlining data collection and enhancing analysis to improving communication and stakeholder engagement, digital tools help organizations produce credible, transparent, and accessible sustainability reports. By embracing technology thoughtfully, organizations can strengthen their sustainability performance and reporting capabilities in an increasingly digital world. Part 9. Assurance and Verification in GRI Reporting. Introduction. Assurance and verification are critical components of high-quality sustainability reporting. They enhance the credibility, accuracy, and reliability of reports prepared using the Global Reporting Initiative (GRI) standards. This part explores the purpose, types, processes, and benefits of assurance in GRI reporting, helping organizations understand how to apply assurance effectively. The importance of assurance. Sustainability reports communicate an organization's environmental, social, and governance ESG performance to diverse stakeholders. Given the complexity of sustainability data and potential reputational risks, independent assurance builds stakeholder confidence in the report, enhances transparency and accountability, identifies errors, inconsistencies, or gaps, supports continuous improvement in data collection and management, strengthens corporate reputation and trust. Types of assurance. Internal assurance. Conducted by an organization's internal audit or sustainability team. Focuses on internal controls, data accuracy, and compliance with reporting procedures. Provides preliminary validation, but lacks external independence. External assurance. Performed by an independent third party, such as an accounting firm, sustainability consultant, or certification body. Provides an objective evaluation of the report's content, data, and processes. Often requested by stakeholders, investors, or regulatory bodies. Levels of assurance. Assurance can be categorized by the degree of rigor applied. Limited assurance provides moderate confidence that the information is free from material misstatement, based on procedures like interviews, document reviews, and analytical tests. Reasonable assurance offers a higher level of confidence involving detailed testing and verification, similar to financial audits. The assurance process. Step 1. Planning. Define the scope and objectives of assurance. Identify material topics and key disclosures to be verified. Agree on timelines and responsibilities. Step 2. Data and documentation review. Examine data collection methods and sources. Review policies, procedures, and internal controls. Assess alignment with GRI standards. Step 3. Fieldwork and testing. Perform sampling and verification of reported data. Conduct interviews with relevant personnel. Evaluate consistency and transparency of narratives. Step 4. Reporting. Prepare an assurance statement outlining the scope, methodology, findings, and level of assurance. Highlight any limitations, discrepancies, or recommendations. Choosing an assurance provider. Factors to consider include expertise in sustainability and GRI reporting, independence and objectivity, reputation and credibility, familiarity with the organization's sector and geography, cost and resource considerations, challenges and best practices. Challenges. Limited availability of skilled assurance providers in some regions. Cost constraints, especially for SMEs. Complexity of non-financial data and indicators. Best practices. Integrate assurance planning early in the reporting cycle. Engage assurance providers collaboratively. Use assurance feedback to improve future reporting. Communicate assurance results transparently to stakeholders. Summary. Assurance and verification strengthen the trustworthiness of GRI sustainability reports by providing independent validation of data and disclosures. Whether through internal reviews or external third-party assurance, applying robust assurance practices helps organizations enhance transparency, meet stakeholder expectations, and drive continuous improvement in sustainability performance. Part 10. Future Trends in GRI Reporting. Introduction. Sustainability reporting is a dynamic field evolving rapidly in response to global challenges, stakeholder expectations, and technological advances. The Global Reporting Initiative, GRI, continues to adapt its standards and guidance to remain relevant and effective. This part explores key trends shaping the future of GRI reporting and sustainability disclosure. Increasing demand for transparency and accountability. Stakeholders, ranging from investors and customers to regulators and civil society, are demanding greater transparency about organizations' environmental, social, and governance (ESG) impacts. This trend is driving expanded reporting scopes covering broader sustainability topics, more rigorous disclosure of risks and opportunities related to climate change, human rights, and social equity, enhanced focus on impact reporting rather than just activities or outputs, integration of financial and sustainability reporting. The boundaries between financial and non-financial reporting are blurring. Investors seek integrated information to better understand long-term value creation. The rise of frameworks such as the International Sustainability Standards Board, ISSB, aims to standardize sustainability disclosure alongside financial reporting. GRI is evolving to align with these initiatives, facilitating integrated reporting that meets multiple stakeholder needs. Emphasis on double materiality. Double materiality, the concept that organizations must consider both how sustainability issues affect their business and how their business impacts society and the environment, is gaining global acceptance. This broadens the scope of material topics and deepens analysis. It encourages companies to assess systemic impacts and contribute to Sustainable Development Goals, SDGs. Advances in technology and data management. Technology will continue to revolutionize sustainability reporting. Artificial intelligence, AI, and machine learning will enhance data collection, analysis, and narrative generation. Blockchain could offer secure, transparent tracking of sustainability data and supply chain impacts. Digital reporting platforms will improve accessibility, interactivity, and real-time updates. Growing importance of assurance and verification. As reporting standards become more rigorous and data more complex, assurance will be critical to maintain credibility. New assurance models and tools will emerge to address evolving reporting needs. Stakeholders will increasingly expect third-party verification of sustainability information. Greater focus on social and human rights issues. While environmental reporting remains crucial, social issues such as labor rights, diversity, equity, and inclusion are receiving heightened attention. GRI is expanding guidance and indicators related to social justice and human rights. Companies are expected to demonstrate meaningful impact and progress. Sector-specific and contextual reporting. Recognizing that sustainability challenges vary by sector and geography, GRI is developing more tailored guidance. Sector supplements provide relevant indicators and benchmarks. Contextual reporting reflects local risks, stakeholder priorities, and regulatory environments. Collaboration and harmonization of reporting standards. Multiple sustainability reporting frameworks exist, leading to complexity for organizations. GRI collaborates with other standard setters, e.g. SASB, TCFD, CDP, to harmonize requirements. Simplification and alignment aim to reduce reporting burden while enhancing comparability. Summary. The future of GRI reporting is characterized by greater transparency, integration, technological innovation, and expanded focus on social impacts. By adapting to these trends, organizations can better meet stakeholder expectations, manage risks, and contribute positively to sustainable development. The evolving GRI standards will remain a vital tool in this journey toward more accountable and impactful sustainability reporting. About the author. Olubusayo Aina is the director of LAREINS, an energy, climate, ESG, and sustainability training institution. He is also a professor with the Global Humanistic University, GHU, in Anguilla. Olubusayo has a PhD in energy economics and finance.